Hey everyone, welcome back to Corporate Decoder, the place where we break down the confusing world of corporate finance and tell you what it all really means. Get ready because today we are diving into a deal that smells fishy from the get-go, a major acquisition that could shake up the investment world. So what we have here is a report from Janus Henderson Group PLC filed on the 22nd of December, but it talks about an event that happened the day before the 21st of December 2025. This filing, a Form 8K, is like a quick alert to the public about big, important stuff happening with the company. This particular filing is all about a deal where Janus Henderson Group PLC, a major investment management firm, is being bought out. Essentially, they are entering into a plan to be acquired by another company. The core of this report is the agreement and plan of merger. Think of this as the blueprint for the whole sale. It lays out all the details of how one company will be absorbed into another. So Jupiter Company Limited, which we'll call parent from now on, is buying Janus Henderson. They're doing this through a subsidiary called Jupiter Merger Sub Limited. The plan is for Merger Sub to merge directly into Janus Henderson. Janus Henderson will survive, but it will become a completely owned part of parent. Now, the juicy part for shareholders. What do they get out of this? Each ordinary share of Janus Henderson is going to be bought for $49 cash. That is a pretty straightforward cash out for the folks who own the company's stock. But it is not just about regular shares. Janus Henderson also has these things called restricted stock units or RSU awards and performance stock units, PSU awards. For the ones that are already vested or tied to certain conditions, they will also be cashed out. The calculation is basically the $49 per share multiplied by how many shares those awards represent, plus any unpaid dividends. For the unvested awards, things get a bit more interesting. These are not just getting cashed out outright. Instead, they convert into what is called a replacement RSU award. This replacement award will be worth the same amount, but it will continue to earn interest and might offer options for investing in mutual funds, all while keeping the original vesting and payment schedule. Similarly, unvested performance stock units or PSU awards will become replacement PSU awards. These will also be valued based on the $49 per S-share deal, with performance goals assumed to be met at 120% of the target. They too will earn interest and have investment options, but the performance-based conditions are being removed. Of course, a deal like this has a lot of conditions. For the merger to actually happen, Janus Henderson's shareholders need to approve it. There can't be any laws stopping it, and all the necessary antitrust reviews, like the Hart-Scott-Rodino Act, need to clear. They also need certain regulatory approvals, and for no major negative event to happen to Janus Henderson between signing and closing the deal. Janus Henderson has also made promises and provided guarantees in the agreement, and these are pretty standard for these kinds of big mergers. They've agreed to keep running the business as normal until the deal closes, but there are exceptions. Crucially, Janus Henderson has agreed not to entertain any other offers for sale. The board is expected to recommend this deal to shareholders, although they can change their minds under specific circumstances, especially if a better offer comes along. Now, let's talk about the breakup fee. If Janus Henderson decides to walk away to take a better deal, or if certain other conditions aren't met, they could end up paying a hefty termination fee of $297,130,000. That is a serious amount of money, showing how committed they are to this specific deal. There are also provisions for reimbursement of expenses if shareholders don't approve the merger, capped at $111,420,000. On the flip side, if the buyer parent backs out under certain conditions, or if they fail to close the deal when they're supposed to, they might have to pay Janus Henderson a termination fee of $222,850,000. It is also interesting to note that Trian Fund Management and General Catalyst Group Management have provided guarantees for some of these payment obligations. This means they are putting their money on the line to back parts of this deal. When it comes to financing, this deal isn't going to be a problem. It will be funded by cash from that investor group we just mentioned, plus preferred equity from MassMutual and debt financing from major banks like JP Morgan Chase, Citibank, Bank of America, Jefferies Finance, and Mufja Bank. Importantly, Trian will roll over some of its existing shares into the new structure, and the deal is not dependent on securing financing, which is a big plus. Another key piece is the voting agreement. Trian Partners, who holds a significant chunk of Janus Henderson's shares, has agreed to vote their shares in favour of this merger. They're essentially locking in a big portion of the shareholder vote needed for approval. This agreement will end when the merger is complete, or if the main merger agreement is terminated. Under other events, they mentioned that on the 22nd of December, they released a press statement announcing this merger agreement. This section is standard boilerplate for companies. It is basically a disclaimer warning you that some statements made in the report about the future are just estimates and guesses. The actual results could be very different due to various risks and uncertainties. They go on to list a whole bunch of potential risks. This includes things like not getting regulatory or shareholder approval, legal challenges, unexpected costs, and even how the company's business might suffer from the uncertainty surrounding the deal. They also mention market volatility, investment performance, and potential difficulties in keeping employees. This part is very important for investors. Janus Henderson will be filing a proxy statement and a Schedule 13E-3. With the SEC, these documents will have all the nitty-gritty details for shareholders to consider before they vote. They are urging investors to read these carefully because they contain crucial information. This section identifies who might be considered participants in convincing shareholders to vote for the deal. This typically includes the company's directors and executives. Information about them and their shareholdings is usually found in other filings like the proxy statement for their annual meeting. Finally, we get to the exhibits here. They list the actual merger agreement and the voting agreement. These are the legal documents that bind everyone together. So, what is my take on this? Janus Henderson is being bought out for a decent cash price. On the surface, it looks like a clean exit for shareholders, the $49. Per share offer seems reasonable, especially considering the company's market position in asset management. However, the real story here is the certainty of the deal and the heavy involvement of Trian partners. Trian is a known activist investor, and their voting agreement makes this deal look pretty solid. The fact that the financing is already secured and not a condition to closing significantly reduces the risk of the deal falling through. This is a massive positive. However, we must also consider the risks mentioned. The success of this acquisition hinges on regulatory approvals and shareholder consent, which, while seemingly likely with Trian's backing, are never guaranteed. The termination fees are substantial, which underscores the commitment but also highlights the potential pain if things go south. Looking at the numbers, it's not a deep dive without actual financial statements, but the immediate impact is clear. Shareholders get cash, and the company's strategic direction will now be dictated by its new parent. The key question is whether this merger will unlock new growth potential or simply lead to cost cutting and restructuring under new ownership. The inclusion of Trian suggests a strategic shift is intended, perhaps to streamline operations or refocus the business. For Janus Henderson, this marks the end of its journey as an independent entity. For its shareholders, it is a cash payout. For the broader investment industry, it is another sign of consolidation. The big payout for Janus Henderson shareholders at $49 per share is a testament to the value of their investment, and with Trian's support, this merger is largely a done deal, barring any major unforeseen circumstances. Alright, that is our breakdown of Janus Henderson's acquisition filing. What is your take on this deal and what it means for the future of asset management? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord linked in the description for more community discussions. Thanks for watching, see you next time.